What's happening, Hardscapers? This is episode 110 of the How to Hardscape podcast, where we talk to you about how you can start and grow your hardscaping business. And today's episode is brought to you by IQ Power Tools, manufacturers of a comprehensive range of innovative power tools with integrated dust collection systems. Check out their website, iqpowertools.com, to see if they'll be in your neighborhood for their War on Dust tour. And today we're joined by Phillip Dedominicis, Managing Director at Menke Associates, who focus on employee stock ownership plans that give workers ownership interest in a company, a subject I wanted to get on the show to discuss the benefits of, what kind of companies these are suited for, and why you may consider this in the future of your company. So without further ado, let's get into this. Today, we're joined by Phillip Dedominicis. He is the Managing Director at Menke Associates, and he's here today to talk to us about ESOPs and everything you need to know about them. That's employee stock ownership plans. And Phillip, thank you so much for taking the time to do this with me today.
You're welcome.
Phillip, let's get started to get to know a little bit more about yourself and Menke Associates and everything that you guys do over there. Can you give us a little bit of context about yourself and the business?
Absolutely. So I am a managing director at Menke Associates. I'm the senior East Coast partner. The firm is a group of investment bankers. I'm one of those. Federal ERISA lawyers who focus on retirement plans, specifically employee stock ownership plans, or ESOPs is the acronym, and then a TPA or record keepers for the ESOP as well. We're the largest ESOP record keeper in the country. The firm has been around for 47 years, which is how long the industry has been around. My boss, John Menke, helped draft the original ESOP legislation. And about 1 in 4 new employee stock ownership plans are created by us. There's 50 employees here. And interestingly, we're 70% owned by our own employee stock ownership plan. And I think we're the only ESOP advisor with our own ESOP, probably because we actually have enough employees to support one. And by coincidence, I worked at Morgan Stanley for 10 years, and they also had an ESOP. And so I've been a participant as well. And some of the things you might hear me talk about today are just my experience as a participant, just like a lot of our clients.
That's incredible. And it's obvious that we've got the right guy talking about ESOPs today with us. So I appreciate you taking the time. Can we start with describing in general what an ESOP actually is?
Absolutely. So an employee stock ownership plan is a qualified retirement plan. Simple IRAs, 401k profit sharing plans, ESOP. So it's all falls under ERISA law, which is the retirement law that Congress created. And there's different ways to present retirement plans for your employees. Most of our clients, not all of them, have a 401k or similar. Usually we keep the 401k at the company and we add the ESOP next to it. Well, what are the two plans? They're both tax-deferred compensation plans for the employee. So this is all money going into something where the employee doesn't pay current income on it. So it doesn't show up on their current taxes. They grow tax-free until their retirement. And then as the money is used coming out of both plans, that's normally where they pay ordinary income. So they're very similar plans. The difference is the 401k, the employee is responsible for how it's invested. It can buy lots of stuff. It just can't buy the shares of the private company where they work. The ESOP can. That's the purpose of it. And Congress 50 plus years ago, when they were looking at this, they looked at the 401k and said, is there a way to put private company shares in there as well? And they just figured out that would be too complicated. So let's just create a new set of rules to allow employees to also be attached to the equity of the firm. So what is typical, and just typical, but not always, there's a 401k. By the way, if the company currently has a simple IRA, it would need to be converted to something like a 401k or just terminated. But 401k, employees' money goes there. Employers' money goes to the ESOP. The ESOP investments are directed by the board of directors of the company, not the individual participant. And the ESOP can also invest in that company's stock, for the 401k cannot. So those are very similar plans when it comes to eligibility, vesting schedules, but it's really the investment side that is very different between the two plans.
What would an ESOP necessarily be used for? Are a lot of companies using it to reinvest into the business? Because it can hold outside businesses as well. Like you said, it's about the board of directors, what they kind of decide to do with that money, correct?
Absolutely. So for new ESOPs, about 9 out of 10 calls that we get, the main purpose of what the board or the owners or the management are trying to do is help address their succession plan. 60+% of adult workers in the US work for privately owned businesses, which means somebody needs to own it next. They all have the similar problem is succession planning from a shareholder standpoint. So 9 out of 10 calls are, hey, we have a retiring shareholder who owns 17% or 50% or 100%, but it's trying to address who should own the business next. 1 out of 10 calls, it's typically younger owners just trying to create a better compensation plan to attract and retain a good employee base. So they accomplish both, but it's just when you're designing the plan, how we're using it, what's the primary thing we're trying to figure out? Most of the time, it's creating liquidity for a specific shareholder or shareholders in the short term. And every once in a while, it's, hey, we're not in a rush. We're not trying to sell lots of shares. We're just trying to get employees connected to company stock because the data says that creates a better company. Mature ESOPs are a little bit different. 10 years down the road when we've dealt with this stuff, a lot of times the ESOP accounts are building up lots of cash, which is a wonderful thing. And then how we look at those investments is different. But early on, the first 10 years, it's those are the two main things we're trying to address.
Yeah, that makes a lot of sense, especially with succession. And it's actually come up on our podcast a couple of times where guys are thinking the same thing. And also to attract employees into the business, which is so crucial in this industry, landscaping. Labor is hard to come by, especially these days. So anything that you can do to make your company more appealing for new employees to come in is always a benefit. But what type of company is a good candidate for an ESOP?
So the nice thing about the industry, it's really a financial tool. So similar to a 401k, there's not like an industry specific, like, oh, 401ks are great here, but not over here. And that's also very similar to an ESOP. It's really a financial tool. There are some minor exceptions, though. So first of all, size matters. Last year, I did an ESOP for 6 employees. They need to be a C Corp. We're not really jumping up and down about that size company, but there was a very specific reason why it did make sense for them. So you can actually go pretty small. If it's an S Corp, then we're looking at 12 plus employees and growing or very stable. That's kind of the general size of the head count. When we look at company value, we're looking at about $1 million of company value. Again, you can go pretty small with these things. It doesn't mean you can't do an ESOP below that value, but there are fees associated with setting up and maintaining it, and we just see that when you drop below that value, the conclusion from the owners tends to be it's too expensive for the benefit of it. But owners need to be a little bit careful. A lot of them, their succession plan is when I'm done, I will sell it. And I'm an M&A banker. I sold businesses for 14 years before I came here 17 years ago. We also sell a lot of our ESOP owned companies. So the ESOP doesn't have to be the final version of the company or the final owner. But, it's really hard to sell privately owned businesses. And I've known that because I've done it for 30 plus years. And the SBA a couple of years ago came out with a study, which I've kind of always known. I was a little surprised at the number, but it was 80% of privately held businesses who go to market, meaning they hire a business broker or investment banker to sell the business, fail. So the point just is you got to be a little bit careful when you're leading up to your succession to really do your homework on both avenues or all avenues, and to also do it early. Because if you wait a little bit too long as an owner and now you have to sell, then it's just really hard to get a decent price out of it. When it comes to industry, if you can own shares, if it makes sense to own shares of the privately owned business as an individual, then there's no reason why the ESOP can't own it also. The exception to that is certain professional practices where state law prevents an ESOP from owning shares. As a matter of fact, they prevent anyone except the licensed professional from owning shares. So if you're a medical practice, dental practice, law firm, CPA, some professional engineering firms, where the state has ownership requirements or restrictions, really, you need to see whether you can put an ESOP within that. The states are slowly changing to allow ESOPs to fit within those industries, but it's 50 states, it's a dozen different industries. So that's the caveat to who may not be able to do, or who may be able to do an ESOP.
Really interesting, especially those numbers in terms of selling a privately held company, especially in our industry where a lot of the times it's basically more so selling equipment, and that's your business if you have no succession plan. I see this avenue of an ESOP as being a good alternative to, say, just selling off your equipment because you have no one able to take over. As long as you've got those systems in place where you have those employees that are kind of bought into the brand, to the company, and they're willing to continue that aspect of the company, as opposed to just breaking off and whatnot. I'm just trying to think, like, with this, is this very much more so for, say, a landscaping company that has recurring revenue on the books and they're continuing to grow that recurring revenue? Because we've got a couple different types of landscape business owners listening to this. We've got those that are, say, doing landscape maintenance, landscape installs for existing employee or existing clients, and they've got this recurring revenue business model. And also maybe they're taking on hardscape projects where they're doing mostly one-off installs of these larger outdoor living spaces. That's kind of one type of business owner listening to this. And then the other is they're just doing those mostly one-off installs for clients, and doing those design builds like that. Do you see one of those aspects being better suited for ESOPs, or could they both definitely work? Going back to that, the recurring revenue business model of landscaping versus the design build, mostly one-off for one client aspect of a business.
It's a great question. And the answer really comes in the valuation part of it. The ESOP, which you create a trust, that's the retirement plans that owns the shares. And the way the law is written is the ESOP wants to buy the shares of the company. It's just not allowed to overpay for it. So that's the trick, is to make sure whatever valuation the system comes up with is a reasonable valuation for what's in front of them. Mm-hmm. Recurring revenues, by definition, is usually better than one-off. In any given year, it may not be from a profit standpoint, but clearly everyone likes recurring revenues. So where we have landscaping businesses where a portion of it is recurring revenues, that's terrific. My company, although we're an ESOP advisor, but we do this record keeping business. We have 1,000 ESOP companies who send us that work. That is recurring. It shows up every year. It's a very valuable part of our business, because when we go to our ESOP appraiser, we can look at this lovely customer base. It shows up every year. There's a lot of value to it. So it's kind of the anchor in the valuation. And then if you look at the legal part of our business and then the investment banking part of the business, that should fluctuate more, because particularly my side of the business in investment banking, it's like finding new transactions. Now, we're really good at it, and we seem to be actually pretty stable every year, but clearly one year that could not be there, but we would still get our recurring revenue. So long-winded answer of recurring revenue helps to get to a nice value because it's recurring. That doesn't mean you can't. We have plenty of service businesses, construction businesses that is more, hey, like eat what we kill. We get business and we don't. So, but the way to get the value there and have a successful ESOP is really then size and history. So if all Menke had, and I'll just, was investment banking and legal, and we didn't have that lovely record keeping part. Well, if we can show we've been around for 47 years. We have all these clients that, we have this massive referral system, and we get all this business every year. That still has a ton of value as well. But it's then more the history of the company, the size, and then even that is where do these deals come from? I have some hardscaping businesses where they get a lot of government stuff, and they're the go-to person for it. Now, again, government budgets change and whatever, so there's some fluctuation in there. So if you can show that you have a good history, if you show that you have some critical mass, so that if one year isn't so great in just the number of projects, but you're still around and you can adjust your workforce to not, be bleeding cash, then that is fine as well. But that's really where we would, and it's normally where we focus first in, does it make sense for you to have an ESOP? Do you have the head count? What might be the value of who you are? And then the neat thing about the ESOP versus a third-party buyer is it's pretty much a theoretical value. So there is a value there. It's just, does the owner like it? Versus a third-party buyer is trying to figure out how to constantly make money if they do a lot of leverage to pay off the debt, and then maybe how to flip it and sell it to somebody else. So it's a great question. It could work if for the one-off project companies, again, if you have some critical mass and have a good history to say, well, how do you get your projects? And there's plenty of companies that year after year make a lot of money. You have a great referral system. You're the go-to people, but there's very little recurring revenue.
Mm-hmm. Now, thinking about this from an owner perspective, when they come to you, have they already kind of approached their employees for the most part about this and discussed it with the employees to make sure that they're, or at least a good amount of their employees, are actually on board with this idea? Or are a lot of people coming to you guys beforehand to see what this kind of looks like, get some consulting before taking it to their employees and saying, we could go this route? And kind of continuing off that question, if it's not going to overload you here, Phillip, sorry about this, but what is a good time frame before, say hypothetically they're going to, start this ESOP plan? What's a good time frame to kind of start this discussion with their employees and with you guys?
Actually, a great question, which I'm not too sure it's ever been asked of me. The employee one, but as far as the process concerned, the set up an ESOP just to have it there ready to fund takes about a month. The discussion to decide to do one is all over the place. Right. Last month, I got 2 new clients. One person I've been talking to for 3 months. The other person I've been talking to for 8 years, literally. Mm-hmm. So, and again, it goes to that question you asked earlier, is why are ESOPs used? And a good portion of them are part of succession planning. Well, the ESOP is a tool to help succession planning, but succession planning is a much bigger picture. There's a lot of more things. It's very personal. It's emotional. There's sometimes family issues or structuring issues. There's all these things that play into that, which we understand and are very familiar with, but we need to address a lot of times 20 different things, and the ESOP is one of those, and how to use it. So there's a lot of planning that goes into, is this the right tool? And so we're very patient with our prospects. We keep very good notes. I got people call me all the time. I got one this morning. Hey, remember me? We talked to you 3 years ago. And I was like, okay, let me pull up my notes and then I'll remember you. So that answers, I think, that one, which is, it's all over the place, but we can actually move very quickly. And that's a nice thing. Like if I was hired to sell your business, well, there's a process, a much bigger process to prep you for that. And then there's is going out to market, which is a very laborious, time-consuming process. The ESOP doesn't have that. Why? We know who the buyer is, and we know that they're a willing buyer. We just need to figure out the price. So it's a much shorter, more nimble process. But even selling a few shares to an ESOP, someone should assume that's 3 or 4 months. There's just a lot of little things we need to do. To the employees, I've had prospects talk to their employees first. I personally am not a fan of it. And the reason is it's a relatively complicated subject, but it's also not up to the employees to decide how they get paid. It's up to the board of directors to decide how employees get paid. That's how all corporations work. I don't decide my pay at Menke Associates. The board of directors decides how they pay me. I may or may not like it, but I don't decide my own paycheck, and I don't decide whether I want a 401k or an ESOP or a cash bonus plan. It's also my belief that anybody who gets asked, how do you want to get paid? They would not say, match me in the 401k or give me an ESOP. They say, I just want cash today. I don't want to be attached to the business. I really don't want anything to do with you. I want to be able to move on any given day, regardless of the tax consequence. That's just my belief. But it doesn't mean it's in their best interest to pay them that day, particularly when they work at a company long-term. We need the company to be healthy. That's why employers offer 401ks, because it's a good benefit, relatively cheap, to entice that person to stay there. ESOPs have been shown very clearly, because there's lots of data out there, it increases employer retention or employee retention, and it makes it easier to attract people to your company. But that takes time. So more often than not, we're dealing with the shareholders first. They have a right to determine their destiny. Then we need to, if they're not also the management of the company, explain this to the management of which style of ESOP the shareholders are looking to do. I need the management team happy as well, and the CFO particularly. Then usually it's executed, and then we explain it to the employees. Now, that's a very important meeting. It's actually part of our setup of the ESOP, and 1 in 4 new ESOPs are created through us. That's a commercial. But we then show up and explain it to the employees. So whatever I'm telling the owners and management that I think is good for them, I'm the one defending it, or the respective investment banker in whatever territory they're in, to say, here's what we just did and why, and here's why we think it's in your best interest to really pay attention to this and be excited about it. So long-winded answer of compensation is not up to the employee. What we've seen, I've done this for 17 years. I've done, 300 plus employee meetings. Nobody walks out the door, and usually it's the opposite. They thank the owners, they shake their hands. I think I have 5 stories of 5 individuals not quite getting it, but that's over, 20,000 employees I've probably talked to. So it's a good thing, or my owners wouldn't do it. No owner I've ever had set up one thought it was good for them and bad for the employee. It has to be good for everybody. And Congress, I think, did something really good. It's a very well thought out product. It's very well vetted. It's been around for 50 years. There's some weird things in it that I'm not really thrilled about. That could be a little bit cleaner, but the mechanism itself seems to work. It makes sense to me. I'm an engineer, so it has to have common sense to it, and it does.
I just want to take a moment from today's episode to thank IQ Power Tools for being a sponsor of today's episode. This episode is brought to you by IQ Power Tools, the firm that builds smart, tough, award-winning, clean-cut concrete and masonry power tools that eliminate dust. Eliminating dust from your job site is smart, it saves time, it saves money, and it saves lives. Keep your job sites safe and healthy for you and your crew, as well as the neighbors and the homeowner around you, and look professional while you're on the job site with these IQ Power Tools dust eliminating systems. Visit them at iqpowertools.com and learn how to implement healthier and more efficient work practices for your next project. And give them a thanks on their social channels at IQ Power Tools for sponsoring the How to Hardscape podcast. Now back to our episode. And thank you for those answers, Phillip. I know that was quite a broad range of questions in terms of answers for it. There's no really one answer for any of these questions, really. But going to back to the owners, how does an owner benefit from an ESOP?
Again, kind of a broad answer. And it is the good part about ESOPs. It's a very flexible product and it addresses many different things. That's the good news. The bad news is it's a very flexible product and it offers many things. So it's different things to different people. And the harder part about setting up an ESOP is not what is an ESOP, but how should this prospect take the biggest advantage of the product? Because 1 in 5 new ESOPs, we're selling 100% of the company day one. That's just what they want to do. But 80% of new ESOPs, we're selling something less than that. And a lot of them, we're not selling anything yet. We're funding it, and then we're selling shares later down the road. So what does that mean to the current shareholders? Well, why do they care? Well, first of all, we're trying to get them at the top of the list. Essentially, is you're trying to get money for your shares. We need a succession plan. Part of succession planning to an owner operator is shares, board of directors, day to day. So a lot of times they're the CEO, they're the chairman, and the only board member, and they're also the owner. But those are really 3 different hats. So to give up day to day, meaning retire all or part, you can't really own the whole thing. It's just I can't just walk away and still have all my investment in here. So the ESOP really addresses the first one, which is let us get you some liquidity for your ownership. You can stay on the board for as long as you want. And now it helps address when might you want to slow down. So that's the first thing, is helping you get money out of one pocket and into another pocket, which any asset manager or broker is what I call them, any broker, when they're looking at an individual's portfolio, this is an owner of a business, as they near retirement, they need to look at their company as part of the portfolio. So, hey, you got a $10 million company, you have a $1 million in liquid assets, you are not diversified. You have a massive chunk in a very illiquid and volatile security, which is equity. You need to take money out of the left pocket and put it in the right pocket. Great, but it's not an easy thing to do. The other thing which you heard is, 4 out of 5 times when we meet people, they're not looking to sell the business that day. They're just looking to start moving money from the left pocket to the right pocket. So you get some liquidity off the table. You still get to run your business. You get to start to relax at some point and go, hey, I don't want to work 5 days a week. Maybe I'll work 3 days a week. You start giving some of your quote unquote control to other people, so that someday maybe you're not the CEO, but you're still the chairman. You can hang around at the business for as long as you want, as long as you're adding value, which is neat because most business owners that I've met really don't know how to retire. But okay, well, how about be a board member? By the way, I have other clients who need independent board members, and you run a business and you understand ESOPs. That's a great skill set that not a lot of people have. So a lot of times that's an easy place. I have some business owners who go back down the corporate structure. Hey, I really like working outside and doing all this stuff. I was so successful, I own a business, and now I'm stuck in the office, which isn't that fun sometimes. Well, you can't go back to working outside if you own the whole thing. But if you get your money out of the business, I've actually had owners go, one sells car, one went back to a chef, one went back into the lab, one's a scientist again. Like you go back to what you love. So it gives the owner tons of flexibility. That's between I own it and run it every day, and I've sold it and I don't do anything anymore. There's all this flexibility in the middle. Then you look at the prospects of the business. ESOP companies work. On average, they do better than their counterparts, and the numbers are pretty staggering at how much better they do. So you're also building a better business, hopefully. And if you didn't sell the whole thing, you're getting the lion's share of the upside of the increase in value. You sold some, but you still own a lot. And then you also get to participate in your own ESOP. So you're selling shares, and then you're also an employee just like everybody else is. And then there's all sorts of other things when it comes to when there's more than one shareholder, of how to deal with family members and other shareholders. There's all this flexibility. So, again, one of the harder parts is first step is, who are the shareholders and what are they trying to accomplish? It's really important that we dig into that first and listen a lot, and then start giving them thoughts back on saying, well, from what you've heard, what I've heard, how does this feel to you? And they go, oh, I didn't know I could do that. Oh, that's really interesting. So it's a puzzle a lot of times. I'm not just selling, here's a product, you either like it or you like. 401ks are relatively straightforward and you got a few options, but it's a pretty straightforward product. ESOP is this extremely flexible product, but it also fits into a much bigger picture of the company because it's company stock. So it's a much longer sale process. There's a lot that the shareholders and the owner and the board needs to understand to go, it makes sense for us. And here's where we see our destiny. Here's how we want to use this tool.
I definitely see it as a tool to be able to get all parties on board and really get buy-in from the owner, the employees, to benefit the company. Can you explain a little bit how a company might benefit from an ESOP?
Well, absolutely. So when I joined the industry 17 years ago, at the time, there was already a couple dozen studies out there that looked at ESOP companies versus non-ESOP companies. And even back then, the data was pretty overwhelming of how much better the company does and how much better the employee does as a participant in the plan. And it used to be, early on, and studies started about 10 years after ESOP started. So about 1984 was the first study. ESOP started in 1974. And they came out every 3 to 5 years. Someone got around to doing a study. Does it really work? When I joined, there was maybe a study every year or two. And now there seems to be about 3 studies a year. A lot of people are focused on it. I think it's also easier to get to the data. But overwhelmingly, and again, I'm a little bit shocked at the numbers, but companies do better. Top line is better, bottom line is better. They are dramatically less likely to go bankrupt. During the last recession, not COVID, but the recession before that, the average company in the US fired or laid off 12% of its workforce. The average ESOP company laid off 3% of its workforce. Why? It's really 2 reasons. One is ESOP companies, if your employees are also attached to the equity value, everyone's chipping in to tighten our belts and figure out how to survive this downturn. But ESOP companies also tend to have stronger balance sheets. There's simply more cash on the balance sheet to protect you on the downside. The data is already coming out for last year during COVID. ESOP companies survived dramatically higher rates than non-ESOP companies. When you look at the employees, the average ESOP participant in the US today currently has 4.5 times the retirement savings of everybody else, every other working adult. When I joined 17 years ago, that was 2 times. That was a big number. Hey, it's twice. It's not like 10% more, 5%. It's twice as much 17 years ago. Right now, it's 4.5 times. There was a new study by the NCEO in 2019, the average 60 to 64-year-old. So someone who was 62 in 2019 who had an ESOP account had 10 times the retirement funds on average than every other working adult in that age group.
Wow. It's
ridiculous. Yeah. But which, by the way, was about $400,000. So somehow magically these work. It's really not magic. When you look at the tax incentives Congress has provided, when you look at these companies do better, turnover goes down, recruitment is easier, there's more margin, which not only means you're worth more, but it also means you have more cash to grow the business. Mm-hmm. So they work. And the nice thing is the data supports that.
And then finally, from an employee perspective, how is an employee going to benefit from this?
Sure. So for the employee, and I answered, part of that in the last one, although you asked just the company, but the company is stronger business, easier to recruit people, easier to retain your employees, and you're worth more. To the employee is you now have 2 retirement plans. Typically, please put your money in a 401k, focus on the value of the ESOP going forward. On average, you should do better. Your company is more stable, but there's also studies like Morale goes up. Well, that's interesting. Why should morale go up at an ESOP company? Is it, my company really cares for me. I have 2 retirement plans. That might be it a little bit. But I think what really changes is how employees see their job description. So, and I'm a perfect example here at Menke. I was hired as an investment banker to find ESOP prospects, explain ESOPs to them, structure their deals, design new plans, and my compensation is very revenue oriented. If I bring in revenues, I make money. Well, the prospects of Menke Associates, although related to revenues, is really profits. We need to be profitable. If we keep losing money every year, then it really doesn't matter how well I do on the top line if I'm losing money on the bottom line. Well, Menke on a monthly basis doesn't pay me for profits. They pay me for revenues. But I am responsible in my territory for a whole bunch of expenses. And why do I care? Well, I care because I think I'm a good employee, but I also care because I'm a 17-year member of my ESOP. I have lots of shares attached to me. So I have the long-term value of the business is really the profits. So I'm doing my job, but I'm also trying to do it very efficiently. We need bottom line. But what we also do, there's 50 employees here, is it also matters how well the investment banker in Chicago does, in Texas does, in California, we have 5 investment bankers. It also, my value of the ESOP depends on how well the legal department does and the admin department does. So how well we work together also matters. So we tend to be more user-friendly to each other. One guy a couple of years ago, he hurt his hip. He couldn't do one of the seminars out in St. Louis. He called me up and said, "Can you cover me?" And then he said, "Oh, by the way, if you get any clients from that, I'll split the commissions with you." I'm like, "They're your commissions. I would do this because it's the right thing for the firm, and you owe me one." So what you'll see with ESOP participants is they start to look at their job differently. One is, I care about the whole business, and that's the concept of owners versus renters. You seemingly, and again, in general, I talk about in generalities, you'll take care of your car more if you own it versus rent it. Your home, for own it versus rent it. Your house, your business, you actually have an equity interest in it. So you just tend to pay a little bit more attention to it. You tend to help out people more. If you're the last one out the door, you turn out the lights, which sounds ridiculous, but hey, if no one's there at night and the lights are on and you pay the electric bill, that just comes out of profits. So that's what tends to happen over time is the employees look at their jobs differently. It's a little bit more interesting. There seems to be a different conversation about ideas. We want your ideas because in our firm, there's 50 employees, there's 50 brains. We have 11 senior folks. I'm one of them who runs the business. We're the management committee. We have a call once a month. We're always trying to look at competition and deals in the industry and all that stuff. But there's 39 other people where we really want to know how to do better. And they're paid through very directly through the ESOP. So that's where we think the employees benefit. It's not only in their pocketbook, but also it's just a more interesting place to work. Like if you go to the ESOP Association conference when we were having them, they have employee communication competitions. How do you communicate with your employee? And they have these booths and they show how they do it. And then, there's awards given out. But if you look at who's presenting that, it's not the management of the company, it's lower level people who've been given the responsibility to figure out what this thing is, promoted internally, promoted externally. I call it cheerleader camp. They're all a little crazy, but that didn't happen by accident. And it happened because the better that company does, they get paid a second time for that. And that's really an ownership concept.
That makes a lot of sense and really clear, Phillip. Thank you so much for your the way you're answering these questions. And then I do have a couple more questions here that I believe are short and are not going to have, I'm sure, one specific answer, as with most of these questions I've been asking you. But if a business decides to go ahead with an ESOP,
Does an employee pay a lump sum based on their years with the business and then followed by like recurring salary draws? Or how is that structured? Does that depend on the owner and the board of directors about how they decide to structure this and move forward with this?
I'm sorry. So was that for the money that goes in each year or when the participant has left the company or both?
More so for like yeah, I believe on that yearly basis. Like once the ESOP has been planned for, how is an employee, I guess, buying into it, like monetarily?
Sure.
Where is
Okay.
that coming from?
So the ESOP is essentially a company funded retirement plan. So
Mhm.
if you have a 401k profit sharing plan, if you have a broad based cash bonus plan, all the same concept. It's just where does the money go when the company has written the check? So typically, just typically, for an ESOP or a profit sharing plan, you wait, the board of directors waits till the year is over. They see if they made some money.
Mhm.
They decide if they want to make a profit sharing contribution to the ESOP. And again, similar to a profit sharing plan to a 401k or a cash bonus plan. And you go, the board has decided to put, as an example, everyone who's eligible gets 4% of their pay. Great. Then the company writes the check to the ESOP, and that's how the money goes in. If you and I were employees at that business, we get 4% of whatever our gross W-2 was. That's typical, but there are variants to that. So if you were getting paid $100,000, you got $4,000. And if I got paid $50,000, I got $2,000. So the board determines how profits are divided at the end of the year. Should it reinvest in the business? Should we buy more trucks? Should we buy another business? Should we keep it on the balance sheet because this weird thing COVID is hitting and maybe we should keep a strong balance sheet? Should we send it to our shareholders or should we make a profit sharing contribution to the ESOP or a little bit of everything? So it's no different than what boards currently do. Hey, we have money at the end of the year, it's profits. How should we spend it?
That makes a lot of sense. And thank you for that. And so if a company decides to go ahead with an ESOP and set this all up, what if has there ever been an area in which an employee just is not on board with working for an employee owned business? That is that kind of like the breaking point between an employee and employer where they decide it's not the place for us? Does that even exist? Is most people kind of in favor of it in terms of an employee? Have you ever heard any stories about that?
So, I've set up over 300 ESOPs in 17 years. I do the initial employee communication meeting. I then get invited back for a lot of my clients to do them on an annual basis or every 3 years or something. So I've been in front of a lot of employees. I think logically this makes sense to everybody, but not everybody gets it. So in my 17-year tenure, I've not heard stories. I've been in the middle of stories. So there's like 5 stories of where a participant just sat there and was not getting it. The one that came out on the good side, these employee meetings usually last about an hour. There was one situation, it was up in Boston. It was a tech company. About half the employees came from Russia. They were now naturalized citizens, but they were working here, but these Russian tech folks. And Russia had just been through that whole privatization of the government industries. It was a big scam to the little people. So they thought equity was a scam. I was there for 3 hours explaining this to them. I went through everything I know about everything, including what I knew about Russia, because someone offered me a job there once. I knew a lot about it. And at the end, they stood up, they shake the owner's hand and said, "This is awesome. Thank you very much." So I believe that it should work for most people. There's a story, a company in New York, one of my earlier clients, it was a blue collar high vac company, 300 people in a room at the Holiday Inn. I'm presenting. This one guy raised his hand and said, it's in proportion to pay, typically. And his question was, well, why don't we all get the same? And under my breath, I said, because we're not a socialist country, at least not at the moment. But it was like, because we measure your product, estimate of someone's productivity is how a company pays you. So if your pay is X and mine is half of X, you get twice as much as what I do. Well, he got up and he walked out of the room, which fine. But the two brothers, who, by the way, this was a program where they had a 401k with no company funding to an ESOP with company funding. So the company was actually going to start paying their employees more. He got up, he walked out of the room. There was a break. The two brothers said, hey, if you see this guy, please pull him aside. We want everybody happy. And this is a group of 300 folks. He never came back. There was the one empty seat. It was a standing room only. There was one empty seat. And so at lunchtime, when I was just going to talk to the managers, they said, well, did you find, I said, well, did you ever find him? Because he didn't come back in. He said, yeah, we found him in the parking lot. We fired him. And I'm like, well, that's pretty dramatic, particularly since these are like the two nicest guys in the world. And he said, look, we hired him 5 years ago. We should have fired him 5 years ago. He never fit in. He was never fit in. He never was a good employee. And today was the day. Those are very, and the other story then is, at another company where this guy at the end, the meeting was over. I said, look, if you got questions, you're shy, walk up to me after and ask questions. So he started telling me how bad it was to own equity, which I thought was really weird. There was a guy standing there who I'd never met before, listening in, and we turned out he was one of the shareholders that I just never met. I met the three principal shareholders. I never met the other 5 shareholders. So he's complaining in front of one of the shareholders how it's bad to own equity. And I'm like, well, that's the data just doesn't support your comment. 401ks with equity. If you want to change your net worth, you need to invest in equities over time. Have always done better than every other asset class, period. But it's a portfolio theory. This is just one investment of many things that you should have, et cetera, et cetera. So I went through all that. And he was still like, no, like, I don't like this. You shouldn't have equity, blah, blah, blah. And the guy who was standing there said, well, you don't like it. The front door is over there. And I'm like, well, who are you? And he's like, oh, he's one of the shareholders. Well, it turned out the guy used to be, one of the heads of one of the unions. And the unions were taught equity is bad. All we want is cash. So, those are outlier stories, but everyone should get it. But again, the management and the board and the shareholders will not set this up if they think it's bad for the shareholders, because that's counterintuitive, because the owners aren't getting all their money day one. They need this employee group to help pay this stuff off and to buy more shares, et cetera. So the last thing you want to do is harm the group that helps derive the profits to pay for this thing in the first place. But it's also why setting up an ESOP, that first meeting, is simply something we do. We want the meeting to happen and we need it to go well. We know how to answer all the questions. We've seen it all before. We're not going to make everybody happy, but who we don't make happy is really a tiny minority of folks.
And yeah, I figured there was some sort of story there. That's why I did ask, because not everybody kind of has the same mentality when it comes to, I guess, their past experiences or whatever they've lived through to help them come to those types of conclusions that they have. So thank you so much for those, Phillip. And Phillip, thank you so much for your time today talking about ESOPs and answering my slew of questions for you. I really do appreciate it. Where can our audience go to learn more about yourself, Menke Associates, and everything that you've got going on there?
Sure. So 2 places. If you want to discuss ESOPs, you can come directly to me at pdedom@menke.com. So it's P for Phil, D as in dog, EDOM, PDEDOM at menke.com, menke.com. Or you can go to our website, which is menke.com. And there's lots of information there. If you're intrigued, you can fill in a form. If you're throughout the country, you'll be directed to the investment banker in your territory. If you want to talk to me directly, just write in the comments section that you want to talk to Phil, period, and you'll get me directly.
Phillip, thank you so much.
Thank you for listening to today's podcast episode. Visit us at howtohardscape.com for more information on this subject and many others. Let us know what you want to learn about in future episodes by reaching out to us on our social channels. We are at How to Hardscape on Facebook and Instagram, or email us contact@howtohardscape.com. Once again, thank you to IQ Power Tools for sponsoring today's episode. Go check them out at iqpowertools.com to check out their War on Dust tour and see if they'll be in your neighborhood this summer. We look forward to meeting with you next week on the How to Hardscape podcast.